The globe is currently deeper in debt than ever before. Among nations, businesses, and people, we owe $315 trillion to each other, about 300% of the world's GDP. Even at a low rate, this means 10% of all global output goes to interest payments alone, leaving the world's economy in a fragile spot. Over recent years, we've developed a method to ease natural economic ups and downs by pumping cash into the system during tough times to spark activity. However, we're not as skilled at slowing things down during good times to prevent overdoing it. The huge pile of debt this has caused is just one sign of this issue, and some say it might not even be the top worry. We owe this money to each other. One person's debt is another's gain, and beyond that, it's just figures in a system. But avoiding economic pain might truly harm our future wealth. In the past, tough times weeded out weak companies and gave economies a chance to shift limited resources to better areas. Now, with digital tokens valued higher than historic firms and countless startups grabbing billions without clear goals, it's clear why more experts want a reality check to calm the hype. It's easy to see why resources might not be used in the smartest way. And wow, what timing! A trade conflict plus rising actual conflicts in key global areas could be that chance. But is this the downturn we must face? Will it help in the long run? And will we let it get that severe? It varies. Ask an economist what 1 + 1 is, and they'll say it depends if both ones act in their own logical interest. This applies to firm definitions of critical terms like a recession. For advanced, market-driven economies, it's usually a prolonged stretch of slow or negative real GDP growth, possibly with a notable jobless rate spike. Some groups set a clear mark, like 2 quarters or 6 months, but even that differs widely. It's vague on purpose, with flexibility, because just saying recession can trigger reactions. Another point to consider is what negative growth really means, as it's not obvious. Growth is tracked via gross domestic product, the total of all final goods and services made in an economy yearly. Since the industrial era, we've assumed new tools, more people, and global teamwork let us produce more each year, and mostly, that's held true. Over 250 years, the world economy has made about 3% more yearly, on average. That seems small, but with compounding over time, today's world makes 150 times more yearly than at the industrial era's start, with a population about 7 times bigger. So, the average person today accesses roughly 20 times the goods and services of someone 250 years ago. Yes, it's uneven, but most are better off overall. Yet, growth hasn't been steady. There were years we made less than the prior year. Some had clear causes, major disasters, pandemics, or crises that physically disrupted production. The recent global health crisis, which closed plants and slowed trade, is a textbook supply shock. If you missed it, maybe check out a fun show like Bluey instead. But there've also been years we produced less without an obvious reason. An alien observing from space wouldn't spot why the economy tanked in 2008, for instance. These are today's common recessions, driven by market slowdowns that spook people and firms into saving cash, which cuts market activity further since firms won't produce if no one buys, and people buy less if their jobs are shaky. These are demand-side shocks. Such shocks seem odd because we could make more but choose not to. Still, they play a key role by shifting resources from overvalued or wasteful sectors to more promising ones, helping the economy recover stronger. The 2001 tech crash, for example, started with a stock market drop but spread as jobless workers cut spending, affecting other businesses. This cleared out weak firms with no real value, freeing up money, talent, and space for stronger companies that grew into today's tech giants. Whether they're good for society is debatable, but they're highly productive. Similarly, the 2008 crash, triggered by flawed home loan systems, moved focus from overdone real estate to other investments, boosting firms that make things. Some countries, like Canada and Australia, dodged the worst due to strict banking rules and less speculative housing, but this may have fueled today's wild property markets. Economists compare recessions to nature's predators, thinning weak players to keep the system healthy. Without them, unchecked growth could exhaust resources, like a herd eating all its food. But recessions aren't always good. They hit new or healthy firms too, like young animals caught by chance. Better policies, like stricter lending rules or incentives for useful industries, could avoid crashes while still clearing waste, making recessions less necessary.